Yeah, I'm looking forward to this. I had a quick conversation with Kevin earlier the week, and there were quite a few, man. I've thought about since we talked, Kevin. I'm like, wow, you've got some depth. How about that? This is going to be cool.
All right. Well, I'm very much looking forward to it and always appreciate our conversations. What's great about it is even though it's a webinar, it's a conversation. So, certainly feel free to drop the questions in as we go.
Awesome. We'll get started here in just a sec. A couple of things I was gonna just as topics update everybody too that I think are relevant. Matthew and I talked to, my goodness, so many of you and so many bankers. I mean, many per day. It seems like most days. And there's a behind the scenes sort of BaaS embedded finance. I would say the watch list of folks moving in that direction is stronger than I've ever seen it before. I know that the media narrative doesn't reflect that, but there is lots of opportunity. And actually, I would say right now in that sort of, that bottleneck of not enough sponsor banks, but lots of cool programs, there are things that anybody should want that are not able to get sponsored right now. I ran into one, Matthew and I, this is about 2 weeks ago, and it was a credit program, credit card for a major brand. And the banker we were talking to didn't have the bandwidth to take it on for, I don't remember, 6 months or something. And
Right.
made the comment that it was, I think, what was it, Matt? He said that it was like the best credit program he'd seen in 30 years. And that's one that, I mean, shopping around, trying to find a bank to take them, right? So that's the environment for anybody that's just getting going or on the edge. And kind of in that note, with the Bats Association, we get a lot of fintechs coming to us, and we do a lot of that vetting. And so if you go to the website or reach out to one of the team, we've actually got a qualifier form. So you can let us know what your bank's looking for, or from the fintech side, they can let us know, what their program looks like, and we kind of match make the two, and we get a lot of those. So if you're looking for very cool, interesting, profitable programs, they are seriously out there right now.
They're everywhere. It's a good time to be a banker.
You bet. Yeah, and I think last kind of update note that I'll make is I would expect, look, a bit of a tragic time, in my opinion, when we see sort of traditional banks going away, a lot of M&A activity. At the end of the day, we can call it 500 reasons, but if you just can't make enough money, that's the net, right? And as we continue to look at sponsor banks from a revenue perspective, off the charts in every category. And there's opportunities, like I said, all over the place. So I guess it's a little bit of a shrug and, try not to scream and smoke comes out of your ears moment. There are awesome opportunities is the point. And I wanted to make sure anybody that's here that is a little on the fence, give us a call. I mean, there's opportunities absolutely everywhere. I want to take a sec and introduce Kevin, who we've had before. Kevin's a buddy. We've gotten to work together for a long time. And Kevin has, shoot, man, you've worked just about every department and role at R&T. Like you built the place, man. So he knows the ins and outs of the topic better than anybody. So he's going to run us through kind of some key trends as well as some sort of case study, really interesting BaaS and embedded finance related stuff as it comes to deposit networks and management that they're running into that are pretty custom things today. So Kevin, I'll pause and kick it over to you, man.
Great. Thank you. I appreciate you guys for having me and for everybody for joining today. So I think it's my turn to share the presentation and get settled in. Okay. Can you see that all right, Matt and Tanner?
You bet.
Yes,
All
sir.
right. So the first thing I wanted to make sure that as I was looking about this presentation and thinking about it, first of all, I want to thank our marketing team for putting everything together. Everything looks great, but the one thing I felt is like there was something a little off with the styling here, and for the nature of this conversation. So I figured this might be a nice added touch. So I know when we had time down on the ranch together, we talked about wearing hats, so at least I could get my colleagues to join in for today. So again, thank you very much for the opportunity. Today, we've got everybody in the spirit of things. We're going to take a walk down memory lane a little bit and talk about the evolution of partner banking. Tanner, as you were just mentioning, there might be some people on the call who haven't fully participated in this, so it might be good just to do a refresh. Then also talk a little bit about partner banking and how it relates to at least our business with deposit networks. What you're finding is that over time, these have become much more complementary and a part of what can help drive value for the many different participants, whether it's the fintech and their customers or the bank. There's a little bit of a interdependency that actually can leverage a lot of what deposit networks bring. And to that point, we'll touch on some of the use cases, some that you may be familiar with, and others that might be new in terms of ideas. You can't have a conversation like this without talking about stable coins and digital assets to some degree. We know that this is still a very much evolving topic, but what I'd like to do is at least put a spotlight on it, talk a little bit about what it is and what it means potentially for partner banking in particular, and then how at least we're thinking about it from a network provider perspective. The last aspect of that, we'll talk about some of the more current trends with an emphasis on some of the regulatory changes that not only have just taken place, but are actually under consideration, which could have some meaningful impacts as well. So that's the agenda for today. So we'll jump right in. And when I was thinking about the theme and how we want to tie it all together, I did find this one quote from Michael Vance, where innovation is the creation of new or the rearranging of old in a new way. And I thought this was particularly relevant for the period we're in right now, because while there are certainly new things being created, a lot of this is still very common where it's rearranging the new or the old in a new way. So I think that's a theme that I thought was somewhat relevant for today. So we know that partner banking has moved from simple correspondent relationships into a much wider set of offerings. As the business evolved, fintechs have expanded their value prop and really delivering more core deposits to banks. And sometimes due to asset size or balance sheet constraints, many banks are offering BaaS services. They can run into scalability challenges. We saw that to address this need, some of the banks, have integrated more complementary capabilities such as ours for network solutions. But then we ran into the recent failures, some market stresses, but then also some maybe poorly defined business models, combined with some macroeconomic changes, have changed risk perceptions around these partner models. The initial regulatory response to that was to really increase enforcement actions and driving more oversight and regulatory compliance. So you have that going on, but then you also have the new administration that is ushering in new regulatory priorities. And then with the passage of Genius Act, you've really got a new trajectory for partner banking. So you have this inflection point of market disruption combined with a whole new approach toward the regulatory environment with the arrival of the digital economy at the same time. So that's sort of like the level set of the environment we're in. So all the topics we're going to talk through sort of have this in the backdrop. Now, the other thing I did do in the spirit of embracing new technology was to challenge ChatGPT to help me with some of the creative transition slides. So I challenged it around the evolution of partner banking. You'll see this as we go through. Some were closer hits than others. But before I move to the next, Matt or Tanner, anything any questions or anything you want to hit on before I move to the next topic?
I think I would just touch on, the regulatory environment's been interesting. I've been telling everybody, look, so much different than what we've experienced over the last 5, 8, 10 years. I mean, we were trying to, some of the words weren't even invented, right? And they've all changed since. And there were no best practices. There was no guidance. There was guesswork, which is largely where the BaaS Association came from, right? Was everybody getting together and sharing thoughts and best practices. And to be honest, guys, along that journey over some years, I think a lot of folks and some of the headlines, had realized that they'd made decisions and choices that you're a little bit trapped, right? Or kind of grandfathered by contracts or what you've done, right? If you look at it today, I look at it as like the golden age. Go back and read every consent order, and there's your damn roadmap. I mean, this is really, really clean, right? I wouldn't say it's completely grown up, but it's much, much more mature, at least in the gotchas and what not to do. That's not to say you couldn't get you might get a slap on the wrist for something, and that things will continue to evolve. But I do think largely the big pain points are worked out of the model. I think that's really important. I think also, we had a downturn in the capital on, let's call it fintech side of the world, the kind of neobank or financial services mission driven companies. But now we've seen a big rise in brands and merchants, right? That could be Home Depot or the local plumber, right? Whatever it might be. And so those are largely what your commercial customers look like, right? And so we're shifting a little bit, in my opinion, from offense to defense. At the same time, I'm seeing a bigger amount top of funnel of those merchants that are looking to do embedded finance things than I've ever seen before. And that's somebody's commercial customer. So you can start to kind of see this trend evolving. I think it's a much cleaner time, but I think as with many things, a lot of banks pass judgment on something. Dad always jokes about uh, the internet, and he remembers from the time, talking to bankers and like, nah, I don't think we're going to do the internet. I don't think that's for us. That's kind of how this feels to me. This is wait, watch, learn, listen, and take action when appropriate. But I don't think passing judgment for or against is still the right move here.
I do like your quote as well. Don't overcomplicate it, right? I mean, we're just taking the old things and making them new again. Same policy, same procedures, same risk assessments, all the stuff and things. Don't overcomplicate it.
Yeah. Okay. So I touched on this a little bit, but I kind of break it into the three phases here. So pre 2010, most of the partner banking was really around correspondent banking, where bank to bank relationships, it could be small, mid-sized banks that are placing excess liquidity or tapping in for cash management, um, checking capabilities. So it's really more bank to bank intra industry. And then if you move to the next phase in the 2010s, and this is actually the last part in 2010, you actually saw early iterations of bank sweeps where you saw the broker dealers with affiliate banks start to move money from one side of that. I was at Merrill Lynch at the time when some of those things started happening. And then when you get to the 2010s, that range, that decade, you start to see now the emergence of fintechs and how they're now working to manage more of the front end UI, UX component with the customers, partnering with the banks, payments, financial management, advent of APIs, really embracement of that middleware connected glue between the two. And then this is where we start to see more deposit network expansion across multiple verticals. So we're not just in the broker dealer space, you're doing more among banks. You're also seeing broader use cases. So that's where that emergence started really kicking in. And then 2020s, you've got much more expansive use cases that are applied. So now it's sort of like the last two iterations magnified. So you're adding new product capabilities, a lot more deposit sourcing happening, high yield savings account, debit plus cash back. And the integration of these networks really became critical to funding for the banks, but then adding layers of insurance to expand the FDIC insurance value prop, but then also helping banks to manage the scale of the programs because they often could be larger than the balance sheet can support. So those are sort of the top level, I'd say, phases. And where we are right now, and Tanner, when you and I were chatting a little bit about this, is like, how do you think about the different business models? There's lots of different iterations within each of these categories, but if you think of it very generally, on the left-hand side, when we talk about enablement, that could be other financial institutions like broker-dealers incorporating more banking and bank-like products. Broker-dealers are a perfect example. They've been doing this a long time where they're adding debit cards, adding things like that, but then really using insured deposit programs, for example, as complementary capabilities to the overall business. And there's a lot more underneath that. When you get to the embedded side, I think to your point, where you either are focused on financial services as part of your core offering, or you're a consumer brand and you want to include financial capabilities for lots of other reasons, there's sort of those two major veins. So we'll kind of talk about it in terms of fintech neobanks within that first, and then the pure consumers on the right-hand side. But you're seeing these lines blur. I think that's really the main thing, is that to the end customer, they're definitely not thinking about the legal structure of who they're working with. They're not thinking about how the plumbing works. What they're thinking about is the experience and how it all fits together. So this layer, when I say a hybrid model, it's really what is enabling the delivery of that capability, irrespective of what services company is delivering that. It's really how do you put that together.
Well said.
So when you
I
talk about the
did this on purpose, Kevin, but those actually line up perfectly with your eras before. And I think that's spot on, right? I think that enablement, I'm thinking of, I mean, you remember years and years ago, we used to call them issuing banks. I was
Mhm.
literally like a kid when I was hearing that. But like Southwest Airlines credit card or whatever it might be, right? And then the sort of the challenger, remember, that'd be the middle
yeah,
in the 2010s, right? And now we're getting into the brand side. It's a cool time.
it was not planned, but that's sort of my era's tour, I guess. To go through it. So now when we look at what products and services were offered or are offered, it's, we've got a lot around deposit accounts, payment services, card issuance, lending. It's really a combination. And even lending is changed in the sense it's buy now, pay later, not necessarily credit extension. So there's a whole range of different offerings, and they're also supported by other services. So whether you're performing the KYC, AML, these are all services that are required to make this work properly. And then the account infrastructure aspect of it. So we know that there's different ways that these can be combined, but essentially these are the products and services that are required to make it all happen. And then with that, what you have is, I'll say, the relationship dynamics, involve the revenue sharing aspects of it, the compliance oversight, and scalability, because what we're seeing now is these are being adopted at such scope and scale that the infrastructure needs to be there to support at volume. So I think that's really the key component now, is that not only do you need to get the legal and infrastructure set up correct, but all parties need to think about the scalability to make sure that they can still support it when the programs grow to a point where you got to get it right up front to be able to support at scale.
I'd say
And then,
those chartered features or functions, requiring a charter, that sort of regulatory moat. What's funny is we all call it the compliance burden, when that's really our last and strongest moat, right? It's more like compliance as a service is our greatest weapon, not a burden, and that's really what's being utilized here.
that's right. And then can you take that and essentially monetize it at scale, as opposed to it to being an internal function? Think of AWS as an example. It's like, oh, I need to solve my own cloud infrastructure, but then how do I monetize that? And that's not dissimilar to this in terms of how that's evolved.
Bingo.
Back to your point of innovation, how do we turn a cost center into a revenue generator? Gotta love it.
Yeah. So now digging a little bit deeper into the deposit sourcing models, these models are really centered around offering deposit accounts through the fintechs or brands. Um, the benefits to each is that the models deliver to the banks really low cost deposits and fee income, and that's really the extension of this. Is that you're able to, for many banks that are in this space, they're able to grow deposits outside their geographic footprint. They can add diversification, and they can add valuable fee income and allowed to compete in a way and grow outside of any limitations of their existing geographic base. And I think that's where we've seen a lot of this, and why community banks have aligned very well with programs like this. And then the challenge is that because the banks that tend to participate uh, are smaller, then it becomes a potential challenge in terms of managing balance sheet liquidity and compliance at scale. So those are some of the trade-off decisions there. So I talked a little bit about what types of products, but then we're seeing a lot more around the implementation of these specific deposit accounts. So whether it's a direct deposit, high yield savings, prepaid cards, stored value accounts, and then kind of dovetailing off what we just talked about with monetizing compliance and infrastructure, the program manager role, like how many of these services need to come together and essentially become packaged for the program, and whether that's outsourced or insourced, that partner bank or fintech acting as the program manager to help orchestrate everything that's needed to deliver the program effectively. That's I'm bundling that under the types of deposit products because that infrastructure coordination is required. And to what you were just describing is the fintech benefits from the speed to market, the regulatory infrastructure, um, leading all toward their customer stickiness and then added revenue streams. And I'd also say, for depending on the type of business model, for many fintechs, it becomes a client acquisition strategy or a lower cost client acquisition strategy. So there's value on both sides.
I think my one comment there, that Matthew and I have behind the scenes just tried to debate ourselves to death, and we can't get around the fact that once you get away from those very dedicated or point solution style fintechs or neo challengers, when you start looking at this as commercial customers, especially if they're larger, how do your own customers not compete with you, right? Think about, we use the grocery store example a lot. One here in Texas that does 5% cash back on a debit card, right? Oh my goodness, how am I supposed to, in my bank, compete with 5% cash back, right? The
Right.
business models are so much larger that the financial services piece is less about revenue generation and more about customer stickiness, and they can monetize it through umpteen other business lines. That really isn't, I mean, it's the definition of embedding finance, right? It lessens the need to make money on that line. So it's a great thing to participate in and a difficult thing to, compete against.
Yeah, because every one of those uh, firms, their model is feeding on staying in the ecosystem. So how long can I continue and stay in the ecosystem? And to your point, if you have other subsidized revenue lines, it's just how does it fit to their broader goal?
Mhm.
So with all of that backdrop, I wanted to spend a moment on the disruption that we saw. I'll call it the synapse effect. Basically, the things that led to the disruption, and then what have we learned from it, and where are we going from there? So I think as we went through those different eras, the demand for the banking services grew, and speed to market became much more critical. That concept of middleware, like anything, starts to become iterated upon. So you have what can be done in one way, but then there are different ways of approaching it to try to do it faster, to try to do it a little more creatively. So then you see a splintering of what was a defined business model becomes something that's the third or fourth order away from that. And then even within that, there are differences within depending on how the labor was allocated. So whether the partner bank's core ledger was the authoritative ledger, or in other arrangements, the middleware provider, or even at the edge was where the actual honest information lived in terms of the true ledger information. So you had this disintermediation of the real data. And then while that structure it really enabled scalability and speed, it created these risks around transparency and reconciliation, because basically the further away you get from the source, the harder it is to reconcile and maintain transparency. So when we saw that these operated without some of the mirrored copies at the banks, there were unclear segregation of programs, and in some cases commingled balances, weak reconciliation processes, opaque multi-bank sweep programs, a whole host of issues that were identified. And the point that you brought up earlier, this is where a lot of the consent orders focused on, is how do we do these things the right way. And I think we've kind of come through that a lot, where there were some material lessons learned, and that's around significant changes in place, much stronger consumer record keeping rules, banks using fintech intermediaries, banks demanding more real-time ledger visibility and mirrored records. Many middleware providers actually shifted their business models altogether, becoming more agents of the bank. The whole concept of a sidecar core versus something separate, where it really is aligned with the bank for that transparency. We've seen a lot of improvement in all of the infrastructure side of things, and right down to having more strength in the contracts in terms of failovers, escrow, what happens if something were to go wrong. All that stuff has been very well worked through, which is great, because we had a problem, and now the market is sort of adjusted to that. And I feel like it's sort of at the right time, because now you have all these other things going on, change in the regulatory, arrival of new technology. It's good that this type of a program now has a more solid footing in terms of an appreciated business model.
I think my one comment would be, a lot of those FDIC consent orders were really simple if you get down to it. Lots of fluff, lots of other reasons, but in short, if we can't reconcile daily, then how can we provide deposit insurance on the day? Pretty simple, right? Lots of meat around that, but that was the easy one.
Yeah,
Uh,
and traceability. It's
Yeah, which I mean,
reconciliation,
we're still untracing the synapse, or Mikola is, right? Trying to trace his way, all of that. So that's a fun, interesting, and terrible, honestly, terrible for the people involved just to watch that unfold. It shows the magnitude of the problem, right? So yeah, being able to reconcile daily. And then I think that ties a little bit into, and I think you're going to touch some of this, Kevin, but account structure, be that FBO, et cetera. And I suspect a lot of that behind the scenes, the quiet conversations I have from the agency side, it's being discussed and has been for, a good while now, but there's things coming, I would imagine.
yeah, I
I
mean,
work.
I think it's more in the spirit of the more things change, the more they're the same. Is like in some respects, or FBO accounts have been around a long time and they've served the market really, really well. And there's always been a need for proper ledgering and reconciliation and how to file an insurance claim. Like all those things have been there and the rules were pretty clear. So it's just a matter of making sure that we don't lose sight of those core principles. Like, even though there are new things that could come, there are new technologies, but in the end, the principles are fairly simple. To your point, is that if you're tracking things, an FBO account creates a lot of efficiencies, but it's just got to be done the right way. And I think that was really the main lesson, is that there's no shortcuts to that. You just have to make sure you're doing things the right way.
And all these banks that got these consent orders. I remember working at Happy State, and Hickman had called me up. Sorry, the CEO of Happy called me up one day and said, "Matthew, so help me God, if you ever put my bank on the bleeding edge, I'm going to kick you in the butt." But I sure as heck fire want to be in the leading edge, right? So I think so many of these banks that went through this were on the bleeding edge. I'm glad they did it. I'm glad we've got a lessons learned. I'm glad we've got playbooks now. I'm glad we've got some findings. So those banks that want to go on that leading edge, now's your chance, and you better jump in quick.
Well said.
Okay, moving to the next phase, when we talk about deposit networks as a complement, I'll just let this sit for a minute. You can take in whether these are good or not, but basically the idea is that deposit networks can provide a lot of support for these programs. We talked about the scalability aspects of it, but essentially each party brings something of value to the other, and each can be mutually reinforcing. And I think that's what we've observed over time, is it's good business for us, it's good business for our client, and it actually really helps the fintechs as well. So how to make it work is really what it comes down to, is what is the right infrastructure, because this is one of those rare scenarios where they can be very much mutually reinforcing. And coming off of the lessons learned and what have we learned, we've had a very straightforward approach where we offer a direct operating model, and on the left hand side you can see the partner bank relationships where the customer of the fintech working with the fintech, it either can be the ledger that is an agent, say, to the partner bank, or those accounts could actually be opened directly. Over time, this has probably proven to be the most resilient model in terms of having that direct relationship through the partner bank. We've had different iterations over time, but like where this really lands, and I think is the best operating model from our perspective, is where that relationship is between the fintech and the partner bank. The integration is tight in terms of that transparency, the money movement between the customer and the bank. Like, we want to face off with the partner bank because that creates much more of a closed loop. And then that interaction between the partner bank and our network is really running through our custodial account and settlement bank. And we're just reconciling directly with the partner bank. Now, there can be circumstances where, for example, with a data sharing agreement, if we want to make sure we're getting information back to end customers in different ways of delivering that. But the core transactional nature of things and the day-to-day interaction is primarily driven between ourselves and the partner bank. Doesn't mean that the fintech is out of the loop. I mean, they are critical in the process, and we want to understand that. But from a contractual perspective, this is from our perspective over time, this is probably a better framework in terms of partnering with programs like ours.
One comment I would make, and I'll try to be careful. I know Kevin would never approach this way, so this is coming from Tanner. But some of the other not R&T related players and models I saw get caught up in a lot of these challenges. You mentioned traceability. I know that was a concern. I got called in on a couple to go through how would we I mean, it was a forensic style nightmare. I have no idea was my answer of unwinding some of these things. And I continue to notice that you guys didn't get caught up in any of the bad problems. Do you have is this why? Is it traceability? I know also you guys have some pre-custom models that you deploy. Do you have a blanket answer as to why? And not, I know you would never throw shade at any
Well, I
competition.
mean, I will say that we support different models because we serve different markets. So, for example, in the banking space, we have our demand deposit marketplace that operates like this, and then we serve broker dealers in a different way because of the rules that govern broker dealers. And I'd say that there are varying degrees of integration and what level of data we get, but I think the key is the principle that we were talking about is that no matter what framework it looks like, having the reconciliation to the end customer information, we don't always, for example, require the full registration information. We need unique identifiers. They need the traceability. We need to be able to have the reconciliation. A lot of the business operates under an FBO structure, but it is with that ledgering in place. So I think that is the key is just having had a strong foundation to start and then everything from there. But it doesn't mean you can't be more creative with certain when we think about different businesses, sometimes it's a matter of opening up a new business vertical, or it could be, and often that's more of a legal construct because you're saying to serve this customer segment with their unique rules, we have to make sure that we're doing everything the right way. So it might be that the technology and the foundation is similar, but there's different rules that are required to support a particular line of business. So you spend more of your energy around sometimes the legal and compliance aspect of it to know that you're aware of and managing all the rules that are specific around that. And then as long as your platform and the technology and the approach is consistent, then you're managing your business in a consistent way. And I think maybe that's probably been the reason where we found that. But I think, there are one of the things that we do well, I think, is think about challenges when people have, and we'll touch on a couple of use cases. Like we like to think we can be creative, but we want to make sure we're doing it in a way that is still consistent with everything else.
Yeah.
Perfect.
So when we look a little bit deeper into the banking as a service and I'll say challenges of partner bank, we've talked a lot about the benefits, but sometimes there are challenges. All of a sudden the program grows, and if you're a smaller bank and you see deposit inflows that exceed your asset base, that rapid growth of deposits can actually start to distort your capital ratios and showing loan to deposit ratios that are off, and then having difficulty in explaining or forecasting your liquidity planning. So this is kind of more of the classic use case of how bank networks like ours can work, because we can be the area where when you have, I'm sorry, I think I jumped a little bit ahead in terms of where this is going, but these are the main challenges, and then how bank networks are set up to support that. So if you have the issue of excess balances, you can address that by sending it into the network for those excess balances into the network. Sometimes it's a concentration risk where the fintechs are becoming a large percentage of the overall book of business. networks like ours will provide the ability to access diversified funding sources when needed to receive, but also distribute those excess balances to reduce the amount of concentration that might be coming from a particular counterparty. Some of the things we just talked about to try to limit the operational complexity. If you have too disparate or too complex, it becomes hard to scale. So I think that's where some of those challenges can be addressed by having a streamlined operational process. We talk about deposit volatility as potentially being a challenge. If you have a non-interest bearing account in a different rate environment, you could see volatility around that depending on how sensitive the end customer might be. What we've found is that some banks will pay a certain rate on balances that they retain, but they can deliver rate and yield from the program to provide a blended rate, for example, that's still competitive, that takes some of the volatility out of a rate sensitive end customer, but not negatively impact the net interest margin and cost of funds from the bank side of things. So there's the absolute balance sheet size and managing that on and off balance sheet, the navigating concentration risk, reducing complexity and volatility. So those are some of the ways that deposit networks can work to support some of those challenges that a partner bank, especially if you haven't gone into this business before and you're thinking about it, and you're thinking about what are all the scalability challenges that we might see. This is where deposit networks can be a nice complement to that.
So think about embedded finance real quick there too. Just you got me to thinking. Take the old stuff and it's nothing different. We did this with public funds. We would get all the public funds accounts in, and then at night we would put those into our depository network. Therefore, offset that capital requirement. And so I don't know that you're doing anything a whole lot different. I bet your treasury, I see Angela out there going, yeah, say it, preach it from a treasury management standpoint, exact same thing. So this isn't anything new. We're just partnering up with fintechs now to go offset that capital requirement.
I just look at it as a different business line within the bank.
Beautiful. Well said.
Because if you're solving for municipalities, public funds, the problem you're trying to solve there is the insurance that's required by the investment policy. But then from the bank's perspective, how can I serve that customer in a cost-effective way, as opposed to finding surety bonds that are paying for that, which are expensive and not always reliable in terms of capacity.
Absolutely.
Or is this where I want to use my securities portfolio for collateralization when it may not be the most economically prudent thing to do? So it provides options. And the bank is going to look across each business line and say, well, how do I need to optimize it? And part of it might be, how do I serve that business line or customer base profitably? And using the tools that are available, you might use your reciprocal book in one line, you might use send only in another, but it's ultimately designing the balance sheet in the way you need to at the bank level from an ALM perspective.
Well said. I've had 3 or 4 bank CEOs that call us up, and when Tanner and I talking to them, we're like, look, we're looking at this as no different than an extra line of business, right? So I can do wealth management, I can do mortgage, or I can go into this line of business. Well said, Kevin. You got me so excited. I gave you a full-on clap there.
All right. Got Matt fired up today.
You're fired up.
All right. So this is where I started jumping ahead of myself. But when we talk about the use cases, I talked about the one where if you have the program growth exceeding the balance sheet capacity, this is where your loan deposit ratio starts to go below the target. All of a sudden, the deposits are outstripping your loan capacity. And then you're going to have unmanaged growth rates as well. And then it increases deposit costs. So there's a lot of things that can happen by a lot of new deposits coming on board. So what some banks will do is they'll choose to reciprocate to a particular target balance, meaning let me keep as much or retain as much of the valuable non-brokered core deposits that I set the rate on. And it may not be that even it's just the first 250. It might be I'll take a larger portion, but I want to use my reciprocal bucket. And then anything above that is above the target that I want to manage internally, I can send into the network for that. So that allows you to achieve the preferred loan to deposit ratio, maintain that target deposit growth, because that's also a consideration. Is how are you managing with the regulators, for example, the pace of growth and showing that you have control over the balance sheet, irrespective of what the individual fintech programs might be doing, because you're not going to have direct control of the end customer and how successful a program is. What you are going to have control over is how you can manage that. So these are um, tools that are available to navigate through different scenarios. And I think just demonstrating that capacity and demonstrating that control is what many banks have found to be particularly useful, especially in navigating volatile markets, to know that they have the ability to move and then gain access to liquidity if needed. That's where this has become very complementary. The other thing we find is that sometimes there are some unique businesses where they may not need like the full 60 million of insurance that we offer, and by having a very large bank list to disclose might create more complexity. It's like, well, if I have a debit card, I don't need high levels of FDIC insurance. What I need is scalability. So there are ways to design a program where you might lower the insurance amount, essentially opt out of a large part of the network, concentrate that. It streamlines some of the reporting capabilities, but then also there might even be more simplistic ways of running the allocation just to keep things simple. So there are some use cases for that as well. Now, sometimes we come into very unique thing. This is where we think we can be creative, is that, right now we're at a change in the interest rate cycle where interest rates are now starting to go down. Over the last couple of years, people have gotten used to a particular level of earnings. It's been stable. We know how this book looks. All of a sudden, a change in interest rates starts changing the dynamics. So, for example, if a fintech was heavily reliant on if they weren't passing all the rate through to the end customer as a big revenue source, for example, how do I preserve that? So we've had one program where we've been able to work with them to create a hedging strategy where they can swap their variable rate for fixed. And then that allows them to preserve the spread of the program, to make sure that they don't have the negative impact if rates were to go substantially lower. So from our end, there's pricing off of Fed funds or off of SOFR. So those are some ways that you can actually create some programs that can be a little bit, I'll say, more creative in dealing with, because this is a legitimate business risk right now. We're entering into a different environment. So depending on how you're managing that, these are the types of solutions that, we can help support.
That's awesome. And, not only is there potential, I'm just thinking through some of these, like there could be some pretty wild upside to that, but maybe even more importantly, there's the opportunity to forecast. I mean, anybody, if you already have a successful business or bank, et cetera, you wanna think about how do I forecast that forward, and I want normal, happy growth, and I want to be nice and safe and sound and keep everybody wonderful. That's a really interesting weapon.
Yeah, sometimes it's more about the predictability as opposed to the absolute earnings, right? Because removing the volatility aspect of it, has other value for sure.
That's cool.
So that's just one interesting use case. And then, the other one was we actually had this relates to scalability, but if you think of like debit cards and different card programs, they can appear simple because it's generally a small dollar amount and don't need large levels of insurance. So you go, oh, well, what's the need for an insured deposit program like ours? It comes down to scalability, because if these programs become extremely popular and they start to grow, with the outstripping of the balance sheet in the first scenario, but now you have a lot of live programs. So the challenge of adding a program like ours, but not disrupting the existing programs that are in place when the bank is acting as the custodian. When I referred earlier about sometimes being creative is not about the technology, it's about the rules and understanding like what does it take to serve a particular segment, understanding how to create, for example, a sub-custodial model where they could preserve the program that they have in place as custodian, appointing us as sub-custodian. We can actually port that over without having to disrupt and repaper everybody and basically add the scalability that they were looking for. So those are just a couple examples of some real life issues that come up that sometimes take a little bit of creativity in sitting and working through the problem. But more often than not, the solutions are there. It's just a matter of working through it and finding the right balance there.
That's another one that could be huge. I mean, that could be that's a deal breaker right there, right? A lot of times if you ended up in the ninth hour and the having to repaper a whole program or not, that could be a deal breaker. That's
Yeah.
cool.
Yeah. So each one of these has its own unique set of circumstances, and but I thought that was just a good way to share some thoughts, particularly for people who might be faced with some of these business challenges, that sometimes there are solutions out there that you may not be familiar with.
Well,
I bet
real
you
quick, kudos to you, Kevin. I mean, this is what I love about the whole BHB ecosystem is if you got a question, we got a cool partner with you guys. If you're a bank, you're thinking about doing this, man, you got some people that you can reach out to, some really awesome experts who say, hey, think about this, give me some pitfalls, let's solution this together. And that's what you guys are there for. I think that's awesome. Had to give you a shout out. Kudos, man.
Thank you. So this is the more esoteric cartoon challenge was trying to succinctly describe the trade-offs between stable coins, digital assets, and the banking system. And I challenged it to use it in haiku form, which is truly the most refined way. So you can tell me if you did it right. Stable they proclaim, yet each coin steals from the vault. Banks grow less steady. So I think it actually captured it pretty well, where it's a positive thing, but if you're removing reserves from the banking system, have we really solved anything? So I think that's a good setup for this conversation. I promise to have no answers for this next section, but maybe some good ideas or
I love
thoughts.
that he had legs and hands. Those are
Yes.
both yep. Says it all.
So for stable coins and digital assets, another quote that I thought was timely was, if you look at history, innovation doesn't come from just giving people incentives. It comes from creating environments where their ideas can connect. And I think that is where we are right now. The change in the regulatory landscape, everything around that is essentially creating the environment where ideas and new ideas, like I've just seen the amount of energy around this over the last 12 months is really about the environment that's been created, and where there will be some degree of certainty in some things. There's more uncertainty than certainty as we're going through it. But I think the impetus is to have the backing to try to solve these problems. So the last 12 months, we saw the surge in attention around it. We've now got the two main, I'll say, blockchain enabled financial instruments, whether it's tokenized deposits or stable coins, large institutions moving in different directions, whether it's adopting tokenized deposits for some use cases, stable coins for others. But I think for banks, the impact is still not fully understood. Risks are emerging, but I'd say that some of those risks are probably more concentrated on the small to mid-size, because it's more pressure to figure out how do you play in the space. There are deposit opportunities for everyone around the value chain, but it's just a matter of where you choose to play. The other part of it is that there's still a lot of work to be done. So even though the act was signed into law, there's still a shaking out period in all of 2026 where we have to reconcile rulemaking across state and federal regulations. All of this stuff is leading toward some inconsistencies potentially between state and federal, which creates more uncertainty. So I just want to make the point that nothing is fully baked as of yet. So there's still as many things that need to be sorted through. We're not living in a world where everything is completely known at this point. But just to give the framework, I'm sure everybody's participated in at least 5 webinars around this. So I'm not going to dwell on the differences of each, but essentially I look at stable coins more so from the use cases that they support. And if we really break it down, whether it's a stable coin, tokenized deposit, the real opportunity is for faster settlement and better liquidity. I mean, that's really the business driver. And the stable coins and the tokenized, they're just the tools of how to achieve that business goal. And there are going to be different use cases for each. We're seeing stable coins, driving more real-time cross-border payments, treasury liquidity management, digital commerce, programmable money. But the key characteristic there is it's got to be collateralized, but there's no pass-through insurance and no ability to pay rate right now. So a lot of the attributes people are looking, but trade-offs from traditional deposits, whereas tokenized deposits could deliver on a lot of those same business goals while supporting pass-through insurance and actually retaining deposits in the banking system. We're just not seeing as much broad adoption yet, and you still have the challenge of interoperability. So they're almost going in parallel with different paths, but they're solving very different use cases from our perspective. And there's still a lot to learn about that. But I know that in the past, we've looked at different forms of money-like instruments, and it can go everything from tokenized deposits to stable coins to algorithmic crypto-based. So I'm going to not include 3 and 4 as part of the conversation. It's really focused around the top 2. I think everybody on this call would probably agree with that as well. A lot more momentum around that. And I think what we're looking at is what are the likely impacts? So community banks, we're saying this is a negative mainly because are the resources there to pursue stablecoin issuance, for example? There could be competitive pressures from large digital native institutions, may not have the brand recognition. So this might be more of a partner scenario as opposed to an individual, just because of the challenges of participating in that market. When you start moving up in size, mid-sized banks could start to participate in that. And as you get to be in the larger side of things, you now have the ability to manage more of the collateral side of it. You start seeing other business lines that are adjacencies to issuance. Fintechs, it's a positive because there's just a lot more options, because if the goal is 24/7, now you have different ways of accomplishing that. You almost don't care whether it's a tokenized deposit or not. Just help me get what I need to do for my clients. So it's more of a banking system thing to figure out. For others, it's more passive. Broker dealers, it's probably more about, do I have them as custody in terms of digital assets? Policymakers, you're seeing a lot of alignment in terms of support, bipartisan, ironically, bipartisan support in a lot of this. But I think the part that's still unknown is how does the rulemaking and regulatory framework keep pace with the rate of change in everything? So those are the types of things that we see. We, as a deposit network, tend to think about it in terms of the more closed loop, 24/7 liquidity, maybe skewing more toward tokenized deposits in terms of like direct applicability to our business. But it's still early on that. But things we're watching are, how does something like a stablecoin become a killer app? It's something like this plus rewards plus all those other ancillary benefits. The value is the liquidity aspect and the 24/7 settlement and all the other things. If you're willing to sacrifice insurance and rate and it's made up in other things, does that become a new battlefield or playing field for competition? And it could be that smaller banks without a clear digital strategy could see attrition as those customers shift toward these more innovative firms, tier ones, fintechs, they're offering digital native experiences. So whether you choose to play in one way or another, at some point you have to decide how you're going to play, because the competition is going to be fierce in different ways. And then we'll say one other thing is open innovation seeds way to digital islands. This is where the challenge of interoperability hasn't been solved, but do some groups create such value that it actually drives these smaller ecosystems that pop up and coexist? Is that where some of these digital or business models could go? So I think the jury is out on a lot of this, but these are the types of things that we're thinking about and monitoring to see, where do we play, where do we not play, where are our clients playing, how can we either be a partner or provide a service, or what would we want to do organically ourselves? So these are the types of things that we're thinking about, but it really, to me, it all comes back to driving toward liquidity, 24/7 access. Like that is the universal North Star. So these are all tools of how to get there. And some are getting there faster because of the latency of others. So it's sort of like stable coins solve a problem because the native infrastructure isn't able to support that yet. So now you're finding ways of achieving the goal and dragging the rest of it forward.
Well said. I think the rewards and the yield conversation is a key one from the fintech side. If they can offer rewards, aka what we would all call deposit yields, then that's a real problem, right? And I think, and there's 3 or 5 parties all in conflict that are all behind the scenes kind of partnered with each other. It's really messy. I think it's going to be CBDC behind the scenes. At least that's what we're seeing play out in behind the scenes of most of these right now. If you looked at, let's say, like Gemini and their CEO, pretty adamant about the fact that this has already been handled, whereas all the bank associations are calling this a unforeseen loophole. And the Gemini CEO is basically saying that's because we kicked their ass on advocacy. So I don't know, right? It's a messy time that needs to be figured out. I think we're also going to see, some of actually, a couple of the large cores have announced. My hunch is they're going to work with Gemini behind the scenes and it's going to be CBDC. But then we get into a technology question of can the core support it and is the core multi-purse? This is a complicated issue with shitloads to be worked out, interdependencies and secret partnerships and publicity, and just there is egg on everybody's face. It is a mess, is where I'm at. I tend to feel about like Kevin that I see more of the or
Mhm.
than the super positive in the short run. But you start talking about 5 years out, and I see game changing super positives, and we got to figure out how to get there.
Yeah, I think we'll go back to our prior theme from earlier in the conversation of the keeping it simple like that.
Yes.
Sometimes it's that type of
Once this
consequence.
is an established thing, I think it leads the way. I mean, think about, guys, some of the things we've talked about from blockchain and smart contracts. Think about things like buying real estate and how all of that goes through the flow and titling and insurance and everything, and then how we could actually tokenize that transaction, right? And use these things to do it. It's the gateway to like really complicated contract law and banking and treasury and all smashed together into push button programming. We're heading there. It's just probably a ways out, but it feels like all of these components are really shaky in like 20 different topics right now, but we're starting to, as a species, tackle them from an infrastructure standpoint. And I think it's a really, I mean, this is the time of opportunity. This feels like the Wild West in banking to me. I see opportunity everywhere, and a lot of it, from my perspective, and this is, I have a banking perspective. I think like a banker, I've been doing this too long. I see a lot of low risk, high reward stuff out there. Things that are cool opportunities to dabble in that have big reward. Uh, Matthew, I'll pause. You got any comment?
Well, I do have a question here. We've got a long-time listener, first-time caller. They went in as anonymous and they asked the question, if the fintech is reliant on the community banks for delivery of its product, how is it positive for the fintech?
Talking about the interest or the rewards piece.
You got it.
Yeah, Kevin, you want to take that one?
Yeah, I think it is a complementary aspect of it because the fintech is delivering generally a wider value prop than
Mhm.
just one product, for example. So if you think about it, if they're solving a problem for a unique customer line, and then they're adding finance as part of it to keep them in their ecosystem. So if you use an Amazon as an example, like their goal is to get everybody to pay a Prime membership and shop through them, and then anything that helps enable that, it could be that the speed of settlement, the payments, but then they might add, I'm just making this up, but oh, if you keep your cash here, you'll make more money too. And that might be a way of getting somebody to join the ecosystem. Or, hey, if you do this, I'll offset your Prime membership fee. And like there's different ways of combining value. So I think the fintech is looking to the bank side to say, what products do I think my client would find valuable? And if they're already with me, how can they access that? And it's a convenience thing. How quickly can I do that? Or buy now, pay later is really just an enablement tool to make the ordering process easy and not have to go to a third party to get approved for credit, for example, to make that transaction. So I think it's just what tool is essentially making the life of that fintech's customer easier so that when they think about doing something, they go to that fintech as their preferred location to do whatever it is they're trying to do. And how does the enablement happen from the different financial services components that sit behind that? That's kind of the way I think about it. But Tanner, feel free to add to
Right.
that.
Very good.
No,
We're
I
at
think that's
the hour, Kevin. You got any final thoughts for us?
I'll just say this, since we're at the hour, there are headwinds and tailwinds, and the rate of progress will depend on the magnitude and scope of how we navigate, because this basically goes through the things we were chatting about. And there are some interesting regulatory developments, which you could literally have a whole separate webinar on this. But I would say the first one up top, the keeping deposits local, increasing the size and caps of reciprocal. For a lot of banks that play in this space in the 0 to 10 billion, for example, if this goes as proposed, up to 50% of liabilities could be in reciprocal deposits. So that could be a meaningful increase. And I think a tailwind for a lot of banks in this space, more tools. And then the one, we're just looking at the other ones, they're not as far along, but the second one just sort of changes the way, it could expand the way non-brokered status could be applied based on fees. It's got some challenges to it in terms of how that's applied. And then the question of whether it would be raising financial FDIC insurance at a zero interest transaction account, gaining some momentum, but still a lot of questions around how that would be implemented. It's got a 10-year, at least the proposal right now, it has a 10-year build-in, and not quite sure exactly how to pay for it. So there's some stuff out there on the regulatory side. And, I think we've hit on it, but these are the key takeaways is that, while the overall regulatory market and business environment is strong, the rate of progress will be determined by any impact and timing of those headwinds and tailwinds we talked about. But it is a very interesting time with a lot of opportunity. And to the extent that we can be a partner, happy to work with you. And we hope to see you at the roundup for those that will be there. So I had to make sure I hit that
I love
before
it.
we ended.
Awesome. Well, I will damn sure be there. I'm looking forward to seeing lots of everybody there, and you two, Kevin and Matthew. I'm sure I'll be hanging out with your ass the whole time. So thanks to everybody that joined us. I had a ball. I actually learned a bunch of shit too. So thank you, man. We'll be in touch on some follow-ups that everybody had, and we'll see everybody again next time.
Thanks, everyone. Bye.
Bye, y'all.